Hello, we are the team from Cornell. This is Amy Wang. I'm Wally Adebayo, and this is Femi Foye. And we are delighted to present to you our strategic approach to ESG investing for university endowments. Now, due to the increased attention ESG is receiving within the investment community, university endowments are facing an unprecedented level of scrutiny with respect to not only how they invest across different asset classes, but also the underlying investments within. University endowments justify not implementing ESG mandates in their investment policy statements for three primary reasons. The first is the perceived lower level of returns. The second is the lack of transparency across the ESG ecosystem as a whole. And third, the lack of viable investment vehicles to gain ESG exposure. Now, we view this as a unique opportunity for Common Fund to leverage its existing endowment universe and propose our solution, which is the ESG Alpha Select Fund. It's a commingled investment vehicle that is risk-based across three different investment preferences that leverages a third-party manager overlay to gain exposure to fixed income, equity, and alternative investments. So again, integrating ESG considerations into a fundamental investment process is critical. Our methodology is going to take a multi-thematic approach whereby we are going to select third-party managers based on a three-ranking system. The first is ESG corporate ratings. The second is ESG sovereign ratings. And lastly, we're going to assess managers on a peer-by-peer basis, which is our ESG manager ratings. We're going to take the three approaches and kind of integrate them into our ESG Alpha Fund, whereby we select the top performing managers that score highly across the three different themes. So now for an endowment analysis, it's important to kind of take a look at the endowment landscape just to kind of see where things are and where things are headed in the future. And I think it's important to understand that, I think now more than ever, university endowments are listening to the voices of everyone in this room, right? Students, donors, alumni, and kind of hearing how we think about, companies and, their practices and how they kind of govern, their policies within. And a good example of that is, Stanford University divested its fossil fuel investments after, student protesting. And I think we're seeing this trend across several endowments across the country where they're just listening to the students' voices and kind of taking action based off of how they feel towards investing. Portfolio enhancement. Strong research suggests that ESG ratings are negatively correlated with stock market volatility. As you're constructing an investment portfolio, that is kind of what you want to see, right? So again, there's a strong correlation between ESG ratings and long-term risk-adjusted returns. And lastly, the future of investing. Many believe that ESG principles will be incorporated into almost all future investments. So we think that now is a good time to implement, this strategy into your investment policy statement now rather than wait until the future. Some of the current challenges university endowments face are resource constraints, right? They don't have the requisite human capital within their investment offices to invest in a nascent investment field such as ESG. Insufficient capital to access top managers. Obviously, top managers come equipped with a substantial fee, and endowment offices may not be able to meet that hurdle. Lack of expertise, again, because it's a nascent investment field, there are a few ESG and SRI specialists to help kind of facilitate the investing on behalf of the university. And an overemphasis on negative screening. This is really contracting the investable universe. Once you screen out for certain sin stocks, certain, alcohol, tobacco, and firearms, it's really contracting that investable universe. So we think that, and what we're proposing is to incorporate, positive screening and not just negative screening when we look at the investment universe. So again, currently speaking, endowments take a passive engagement to investing in ESG. So you see that bottom line, traditional investing, negative screening, and ESG and SRI indexing. We're going to, push that up to the active engagement side and really focus on shareholder activism, ESG factor investing, and lastly, impact investing. So again, I think from Common Fund's perspective, it's important to understand the addressable endowment market. We took some data from a Nukubu 2004 survey. The number of respondents in this survey is 831. Now, 25% of the respondents said that they would not incorporate ESG into their investment policy statements. No ifs, ands, or buts. So we stripped those out. And the remaining addressable market left 168 potential clients, as well as 370 billion in AUM. We see this as a very attractive, kind of market to address. Risk profiles across the different endowments, they can be from conservative, moderate to aggressive. We have the ability to kind of slice our portfolio to kind of meet each endowment's risk preference. Now I'm going to hand it over to Amy to talk about the fund overview.
Thank you, Wally. So what we're offering here is a fund and a solution. It's a product and a solution. So what we're pitching here is the ESG Alpha Select series, and the purpose is to generate long-term competitive returns that are suitable for university endowments across a wide range of asset classes. We're forecasting target returns of 6.2% to 13%, with minimum investment sizes of $27.5 million to $200 million. For more detailed analyses, the first page of the appendix actually lays out the different tranches of AUM and the respective minimum investment amounts and percentage AUM that we think is a good size in terms of bottom-up and top-down analysis to actually gain a meaningful ESG allocation. We are also in the business of the investment management business, correct? We are pitching that common fund charges a 15 basis point management fee for one, doing the manager selection process and the screening and the monitoring, working with clients to improve their investment policy statement, and also have a role in talking through some of the tranches that I'm going to show on the next slide. We are also asking for a lockup period of 1 year. So our approach is to focus on the top side, shareholder activism through private equity firms and equities, ESG factor investing across all asset classes, and impact investing. This is where all alternatives really play a big role in having an active hand in incorporating ESG factors. So the way I like to look at this is we're going to lunch and you're given a tray. You're back in grade school where you have your side for your meat, your veggies, dessert, and your soda. Now, what kind of tray do you want? We have 5 options. Conservative, moderate, aggressive, those are our baseline. We are pitching a 65% allocation to equities, one, because this is a very transparent and mature market in terms of incorporating ESG investing. It's also very liquid. Within fixed income, in the gray, we believe that this is a source of capital preservation as well as natural liquidity that endowments can tap into when they want to withdraw 4 to 6% for their uses every year. We believe that alternatives are a significant way to get growth returns as well as exposure through real assets, private equity, venture capital, and impact investing. So I took our sample portfolio for moderate and broke it down further into the different equity, fixed income alternatives that we have. Again, a well-diversified plug-and-play product that, depending on what a client needs and where they are in terms of AUM and their current allocation within their existing portfolio, they can rebalance and reallocate into our Alpha series as a plug-and-play product that's ready to go. One way to incorporate flexibility is to use derivatives. We propose using swaps to remove and add exposure. One example is coal companies with exposure to the MSCI Global ESG Index in exchange. So this allows every client to have that customizable experience depending on the risk and return needs of their endowment as well as their own personal preferences. Now, common fund is a business, and I wanted to talk through some of our assumptions here. I'm assuming through Morningstar, 75 basis point fee for equities, 60 for fixed income, et cetera. Weighted across the 65% allocation and the respective fixed income alternatives, the average fee comes out to around 100 basis points. I am also estimating that about 40% of our clients are interested in a moderate portfolio. And assuming a 15 basis point management fee and a 10% penetration of the market value that we address, 370 billion. So 75% of 370 billion people, 10% of those, so 7.5% of the 370 billion as the potential client base. Common fund could see a 42 million source of revenue through the 15 basis point management fee. And right now I'll hand it over to Femi, who will talk a little bit more about our implementation.
Great. Thank you, Amy. So let's get to the fun part. Let's talk about the fun stuff. Everyone's here to talk about ESG. So we're having a two-factor approach, which is looking at ESG on a corporate analysis as well as on a sovereign analysis. Let's start on the corporate side. So we're going to ask all our managers to tilt their portfolios and focus on particular areas of interest, and these are the areas for you. We call these our sweet six because they represent E, S, and G, and whereas we think are very important on the environmental, social, and government side, highlighting things like clean energy, social equity, as well as workplace diversity. We think corporate clients have a real hand in actually driving the conversation here and making change. On the sovereign side, some of our managers may be macro in nature, because we're looking at all managers across all asset classes. Also looking at how governments can play a role in this. So looking at things like CO2 emissions, looking at things like income equality and access to healthcare. These are important for sovereigns to take into account. So we ask our managers who take both a bottom-up and top-down approach to factor this into their entire investment process. So now let's talk about implementation. How does this actually work? Step one. So we use the MSCI ratings, and so we assign individual ratings to these, looking at a sovereign rating score. So from a top-down perspective, how are you investing? And we assign a score to you. Second, from the bottom up. Now we're looking at the ratings as well, but we have a little more tilt here on the social and the government side, because we think corporates have a really, really strong hand here in sort of driving social change in these particular areas. And social and governments think it's somewhere they have a little more than environmental. However, environmental is still a large part of the consideration set here. Thirdly, now looking at fund manager performance. So how do you perform against what your criteria, what we're asking you to do? So looking at your performance versus a benchmark, looking at things like your proxy voting track record, also looking at your adherence to our ESG mandate. Are you actually delivering on the qualitative factors and quantitative factors that we're asking for? The thing at the bottom that I really want to highlight are the bottom two. So all our managers must implement the PRI standards to be a part of our platform. So that's a must. If you're not adopting the standards, you can't be a part. You're automatically screened out. But also, I want to kind of rate your engagement with management on driving ESG change. So we want our fund managers to be very active stakeholders in the companies and countries that they invest in and drive this ESG change across the board. And then for performance evaluation, so it goes in two tranches. First thing, we're asking for all our managers to produce quarterly reports covering these particular areas. So ESG developments in the asset class in general, their record of their proxy voting with ESG in mind, as well as their ESG integration of the PRI framework. This is how they're being rated to stay on our platform. Also, their ESG investment intensity, meaning how much of their portfolio returns is derived from that ESG specific focus, and teasing that out to really drive that performance. Also, and then we produce an annual common fund ESG report for all our clients. The bottom was what we really want to highlight, the carbon footprint. A lot of endowments are really focused on CO2 emissions and the carbon footprint. We want to give them a snapshot of what the endowment profile in total represents of their carbon footprint across the board. We're also sort of analyze ESG performance attribution as well as a proxy voting track record, so they get an idea of what their actual money is doing. And then here's your strategic approach to ESG investing. So very similar to traditional investment management and outsourcing to third parties, ranking managers on our ESG scale, how do we identify them, then putting out the RFPs, and then going through the whole process. No rocket science here. Common Fund is a leader in this industry already. And then some key considerations here. We think the first thing is the investment policy hurdle. A lot of clients are struggling with the idea of getting the IPS statement to adapt to ESG. We're changing the conversation. What we're saying is that ESG should be a factor in the investment management process, not a separate asset class. All managers should take ESG into account. So when you go down to the second factor, which is the limited universe of ESG investors, we kind of eliminate that. We want all managers to become quote unquote ESG investors, not because they only focus on ESG only investments, because they've taken into a factor approach across all asset classes and across all considerations. And lastly, investors want proof. So we think our fund is a way to substantiate the proof that ESG thematic investing actually works. So to recap, we're promoting a co-mingle fund heralded by Common Fund, which focuses on manager selection using ESG thematic process. A co-mingle fund is very well diversified, includes small clients and medium clients as well. ESG integration using manager screening, as well as our ESG sovereign and corporate ratings, and that's how you get to our ESG Alpha Select Fund. Thank you for your time. Thank you for your attention. I know it's been a long day, and if you have any questions, we'll field those now.
I have a question. So on the third slide, you talked about portfolio enhancement, and you said the correlation between ESG rating and long-term risk-adjusted returns turned significantly positive in recent years. What's your source for that? Where did you find that data and trend?
There was a study published through one of the prestigious universities where they did an analysis on, returns versus correlation with returns to the market. So that's where that came from. University published report.
I have two questions. One is, in your summary on screen, it looked like the low end changed to 6.2. In your handouts, you have 8.2. Did something change, or is that a typo?
Yes, we had an hour to modify our slides.
Okay.
We didn't want to use
Why did the target-
historical returns.
Why did the target
predict future
return change in
returns.
1 hour?
I'll answer that question. So we use historical returns to predict future returns. So obviously you can't use the past to predict the future. So we just discounted the returns by 200 basis points.
200 basis points.
Yes.
2 full percentage points.
Yes.
Across everything.
It's a conservative measure.
It's a conservative measure, absolutely.
Could I follow up on that?
Yeah.
Because the same slide kind of caught me, because all of you are 65% equity, right? So you're only changing the 30% of the portfolio, and yet you're getting, well, in this case, 7% improvement in returns on the portfolio level. So sounds to me like that would be something like a 20% differential in returns between government and alternatives. Seems a little high, if I'm getting the math right.
That's about right. I like the Goldman calculator.
Just
Can't get anything past you, right? All right, so here are the sample returns that are broken out over the 5 different lunch trays that I talked about earlier. The 9.6% are geometric returns pulled from NYU Stern. This is through 1928 through 2014. So we're assuming about 10% for equities, 3.5% for fixed income, and 25% for alternatives. And yeah, so hence why the haircut. We want to keep our clients happy, not promise them 10 and show up with 6, for instance. By the same time, we know that they need to withdraw 4 to 6% of their endowment every year. So built-in liquidity, capital preservation, returns on principal, these are all very important in terms of achieving the sort of returns that we laid out.
And then just on your last slide, key considerations. The sentence says benefits are more difficult to prove at the portfolio level, yet your whole product is a select alpha at the portfolio level. So isn't that inconsistent? And by the way, the IPS can still have impact metrics in it without it being an asset class. But
No, perfect. I think what we're really trying to highlight is really just common pushback on the whole ESG mindset, not what we're actually pitching here. Understand? So what I'm more so speaking to, sort of common misconception about the challenges facing ESG. What we're saying is that common fund can lead the way and actually show this not to be the case. So I'm actually being solution oriented and not problem oriented.
okay, great. And then one last thing, talk slower.
I'm sorry. I have a really bad habit. I apologize. It's the New Yorker in me.
One of the features you have an asset allocation that favors more allocation to alternatives depending on how it gets a return. How will this asset allocation change if you were to take a price of carbon or a scenario where climate risk will become real, or you're taking a very constant view of carbon and climate change in all the scenarios?
So that's a really So that's a really good question. What I would say, instead of making up an answer for you, I think that warrants further research and further deep dive into the actual portfolio construction process, and also looking at carbon. I think right now we're taking a very baseline approach to carbon. I think some changes in the policy would affect the actual portfolio construction. However, I think we are kind of offering flexibility to our clients through the swap options who may feel a little stronger about carbon and other particular cases in their actual portfolio. They get to swap out some of those returns. So although we don't have a particular answer for you, I think there's room for further sort of conversation. I can get back to you at the end of the conversation or end of the presentation with a more detailed answer.
On your second to, or I guess third to last slide, the fund manager performance scorecard, Yeah. So the line that says ESG risk-adjusted return,
Yes.
you are suggesting that you will be able to measure and monitor that across your fund of funds and report that to us. And you actually said this, not verbatim, but that you will be able to deliver to us the attribution to risk and return of the ESG factor.
We want our fund managers to do that.
Okay, so
That's a mandate for them to get the
what
capital.
tool will these fund managers do that with? And which tool will you use to see if they're doing it right and deliver it to us?
I think this is a very integrated process with fund managers already. You kind of go to fund managers and ask them sort of how do they actually track their returns? How do they actually track their performance attribution? And then adopting some of those principles and moving it up to the fund level and kind of doing it kind of in twofold.
Have you ever seen a fund manager do that yet?
We've seen performance attribution or with
Of
ESG
the
in particular?
ESG factor?
No,
Like
but we
actually measuring the contribution to risk and return of an E, S, or G factor.
I think the way we're sort of thinking about it is sort of the ESG investment kind of intensity, which is you're looking at their underlying returns and seeing that where are the returns coming from companies on the company-specific level that are driving sort of a lot of their performance. And I think from there you can tease out a little more of the performance attribution. It's not a direct science. And again, a lot of what we're pitching is innovation. Honestly, ESG investing is an innovative space. So we don't have all the answers today, but we think Common Fund could really drive the conversation and work with fund managers to produce this kind of content moving
I will
forward.
give you one answer. Alex Edmonds of Wharton and London Business School has done a 4-factor alpha on ESG specifically to human capital.
Exactly. I was going to say that next. Thank you very much.